Hello, I'm Donald Leggett and welcome to Share Views, brought to you by London South East. Today I'm speaking to Ranjeet Singh, Director at London Stone Securities, who joins us for a 6-monthly update of the markets. Welcome, Ranjeet.
Thank you, good to be back.
It's good to have you. Okay, let's straight into the action. You've been investing for many years, Ranjeet. So how do you see the markets today as 2017 comes to a close?
Well, it's been incredible, hasn't it? The journey's been really good. Lots of people making lots of money. A lot of clients are thinking, when's the bull market going to run out? At the moment, I think we're going to see a continuation. I think we're going to get the Santa Claus rally, which we have every sort of December, January time. But I am wary personally that the market's going to possibly correct beginning part of next year. And the reason being is because we've been on this massive bull run. We've got Brexit. I know we're not going to talk too much about Brexit, but Brexit situation is happening at the moment next year, which I think could. Do
you think Brexit's going to overhang the rally?
I think it's so big, it's so powerful. The negotiations aren't going very well with David Davis and Theresa May, and I think it's going to have an impact. So at the moment, my view is, you've got to be very, very careful. People are making lots of money. It's good, but I don't think it's going to last. And I think it's a very, very good time to start being cautious, have a plan B. Personally, at the moment, what we're doing is investing overseas, investment trust, global diversification, and what's really important is hedge your portfolios. A lot of people, I always use the analogy, if you go out, it's a beautiful sunny day, you walk out, you don't know when it's going to start raining. And it's my job for my clients to make sure they carry an umbrella with them. So I think the market's good, but I think next year we're going to be in for a rocky time.
So are you recommending frontier markets? Are you recommending emerging markets? And anywhere apart from Europe? Anywhere apart from the UK?
I think I think Europe actually will do quite well. I think France will do well. I think Germany will do well. I'm taking slightly a risk-on approach in Italy as well. My ex-wife's Italian, but there's no bearing to my investment decisions. But I think UK particularly is overvalued. I think the US will slow down. A good place to invest, which might be quite bizarre, is Vietnam. We've made 40-50% in Vietnamese funds. I'm not hugely a fan of Vietnam generally, but this year for some reason it's done really well. But you've got to diversify. So
it's a communist state though, so you actually got capitalist interests working inside a communist state. Is that a tricky thing in Vietnam?
I think so, yeah. And also you have political instability, you have regulatory differences. But I think where I see a risk also is an opportunity, because a lot of the big hedge funds don't invest in these areas. So you find that a lot of companies are undervalued, probably 30-40% below discount to the market net asset value. So you're looking for opportunities that really aren't there. If you look at the big funds, everyone's in there. So you've got to.
Have you found yourself a nice fund that's in Vietnam?
I found a couple, yeah.
Are you going to share them with us? You just can't remember them.
I'm just going to remember them for now. The only reason, because I've got a material interest in the funds and I've got to be a little careful what I say. And also, I own some of these funds myself.
Okay, so. Very good. So people like Hargreaves Lansdown and the Share Centre describe themselves as brokers. Yeah. You describe yourself as a broker. So in what way are you different from them?
Basically, we're better than them.
No, come on now, Ranjeet. That's a terrible answer.
No. It's what we do and what they do is completely different. You can't. Hargreaves Lansdown owned 46% of the total investor population in the UK. Just an example. That's what they have. So they have huge number of clients, retail clients. Most of their stuff is execution only. Share Centre very similar. So now we can't compete with that. So where do we add value? That we give advice. So we are more bespoke, we're more personal, we create strategies. For example, if you think the market's going to crash and you're with Hargreaves Lansdown, they're not going to be able to help you how to protect yourself, other than perhaps going into cash. That's the only thing that they can suggest. And that's okay. And don't get me wrong, Hargreaves Lansdown is a great platform. I have nothing but the utmost respect for them. I know a lot of people who work there, but we do different things. So if you're an individual who doesn't really want a lot of help, wants a very good platform, Hargreaves Lansdown is probably the place to go. But if you're saying, well, actually, I want to produce what's called an alpha return, I want to get more than 8 or 10% that the market might give me, then you need to think outside the box, and you think, I'm a bit of a contrarian, Donald. So you've got to think of different strategies, and that's where we come in and say, right, Vietnamese funds or hedging strategies or whatever it might be. So that's the big difference between us and them.
So that's where a London Stone Securities type advice is useful.
Yes, exactly. So if you're looking for something different, you're looking for, for example, we have a lot of our clients are in their 60s and 70s, so they look for inheritance tax mitigation strategies, they look for boosting their income, they're concerned about, situation with, for example, increase in income taxes and things like that. So we kind of create the whole financial planning, the whole tax side of things, putting it all together, if their kids want to have a junior ISA. So that's the kind of thing that we look at. And as I say, the main thing really is not always to make money. I think making money is relatively straightforward in a rising market. The big difference is trying to protect them to stop losing money when we get another crash. And unfortunately, it's been 10 years since 2008. Another crash is probably going to be on the horizon in the next couple of years.
Investors may have forgotten about crashes, do you think?
Well, I don't know. It depends how long they've been investing. But if you're investing anything more than 10 years, you would have remembered probably the biggest crash in the last 100 years. And they're severe. And the worst thing is, of course, when the market crash comes, it's far more severe than when the market goes up. So you always get a 30-40% drop in the worst case scenario. I mean, I don't think we're going to see that, but I think we might see 10, 12, 15%. And
so where are your clients invested at the moment, and what are your defensive strategies that you're developing for them, given that you think there's a correction coming?
Okay, so it's an odd one because it used to be utilities. So in the UK, utility sector was obviously very good. The likes of Centrica, SSE, these sorts of things. That all changed when Theresa May gave a speech this year, about bringing in energy price caps. So now that's all gone out the window. So what used to be your low-risk investments become high-risk investments. So now we're looking at further afield. So property, I don't think is good. Financial is not very good. We're looking possibly at, as I say, investment trusts perhaps, diversified assets, technology I still think is very, very good. And we're also looking slightly further afield. So we're looking at...
Technology in the UK or technology in the States? Are we talking FANGS?
I think more US, I would say. So I still think there's value in the likes of Google and Amazon and Facebook. As ridiculous...
Amazon's not going away, you're telling me?
No, I don't think so. I think we're good with that.
I think I'd agree with you there.
Yeah. Apple, I mean, these are huge companies, but they have a huge monopoly now, and any sort of competition that comes up, what do? They just buy them out and just take them over. So I think that is a growth area that we're going to continue to see. So I think got to be very careful. But like I say, the truth of the matter is that it doesn't matter how good you are. You could be the top hedge fund for Goldman Sachs or JP Morgan. Nobody really knows the direction of the market. I've been trying to find the direction of the market for the last 20 years. I still don't know the direction.
Right. So, nor have you ever predicted the top or the bottom, I guess.
No, exactly. And
it doesn't happen.
It just doesn't happen. It just doesn't happen. You try, and especially in the early part of your career, you think you're going to find it. You find the holy grail, and then you realise actually it's all completely fortuitous.
So what's the trick? You ride a trend.
You ride the trend, because the market always goes up in the long run. So it's like property. Prices always go up in the long run. It's been like that for the last 100 years. So that's going to happen. So all you've got to do is ride the wave. You make yourself your 8 or 10% per annum, which is typically what the market will give you. The market doubles every 10 or 12 years, typically again. So that's great. The reason people don't make consistent returns is because that 1 year or even that 1 3-month period in the 10-year period when the market crashes, people aren't aware. So my belief is, don't focus so much on looking for the next investment or the next Apple, because you won't find it. If you can concentrate those resources on finding a way to protect yourself in the market downturn, and you get yourself 8 to 10%, then you're going to be quids in.
Okay, so you like Vietnam, you like technology in the States. What else are you advising your clients?
So we're looking at income-based strategies. I think income's still very much undervalued. I mean, we do a lot of mining shares, oil and gas. I know you guys obviously look at oil and gas companies, so we look at a lot of oil and gas companies. Yes. But I think in terms of our client base, typically a lot of them are sort of fairly low to medium risk investors. But people are now looking further afield. If you look at, for example, and most people's portfolios didn't go up by that. But why was that? Because it's oil and gas and mining shares. So you've got to be very, very sector specific. If you're going to try and create a portfolio and you want to diversify...
Oil and gas and mining, you see them as cyclical and quite medium to high risk?
I would say they're medium to high risk, yes, certainly. I mean, I'm quite bullish on oil at the moment. I think there's obviously...
$65 a barrel?
Yeah, I still think there's probably some scope there. I know when oil was at $25, $30 a barrel, people think, oh, this is the beginning of the end. But people are still using oil. I think, long term, it's a declining industry. But
it created a shakeout in the industry, and those who've survived that shakeout are actually stronger as a result.
Exactly. And companies that can continue with good dividend cover, like the BPs and the Shells, they continue paying good dividends as long as the dividend doesn't get cut. I mean, that's a big risk at the moment. In the last 6 months, we've seen Provident Financial cut their dividends, we've seen Dixon's, we've seen... what else was the other one? Hickman Pharmaceutical, I think they fell quite dramatically. Carillion was, of course, the worst one. They were, £2.10 a share. I think they're now at 20 pence. So companies that pay good dividends are good, but you've got to make sure the dividend is covered. And I think a lot of companies at the moment are overstretching themselves. I mean, an interesting statistic you might want to know is the dividend cover at the moment is the lowest it's been since 2009.
And what does that mean?
Because the dividend cover is basically the ability for companies to be able to pay their dividends. So if a company is paying a dividend, say 6% or 7%, looks very attractive, you might say, well, I'll take a bit of that. The problem is if they're not generating enough profits to pay that, then that's not a sustainable position. So
that's your analysis. That's the issue.
Yeah, exactly. And the company can't, because the company, if I'm only earning, as a company, only £10 million, but I'm paying dividends on £15 million, that £5 million has to come from profits. And I can only from retained earnings. And I can only pay that so many years before I run out of cash. So the idea really is that you don't necessarily go for companies that pay the highest dividend. You go for a company that pay a good dividend, but have a good dividend cover. And that's the kind of process that I do. And people who fail to recognise that principle, which is a really important one, they end up with Carillion, Provident Financial and things like that.
Because you want a sustainable business as opposed to one which is actually paying out all its profits to the shareholders at the expense of running the business and growing the business.
Exactly. So you need to have a strong board on team, because you become very unpopular as a CEO if you say, well, listen, we're only going to pay you 4% and the guy next door is paying you 8%. But the guy paying you 8%, are they really paying you 8% because the company is doing well, or are they trying to appease you? Because quite often it's a very short-term thing.
So what are your dividend picks at the moment then?
Best dividend picks, I would say, probably right now, I would say,
what do you like?
Well,
not the high ones, not the low ones, somewhere in the middle.
Well, I'll tell you what I do like, which is really kind of quite contrarian, because I was talking about utility stocks. I said, if the energy price caps don't come in as severe as we expect, then I think Centrica could be a pick of the year for 2018. Because Centrica at the moment is at 140 a share. There's a big risk, there's a huge dividend on the table, but if it turns things around, I think that's going to be really good. So utility stocks, I think, could fall back into favour. Depends on where we are. If Jeremy Corbyn comes in...
Politics-wise, Brexit is actually going to dominate everything. What else is actually going to get done in the UK apart from Brexit? Not very much. So it may well be that energy caps become less of an incentive for the government.
Yeah, I think so. I mean, who knows? I mean, Theresa May may not be in power in 6 months' time. Jeremy Corbyn... Mind you, if Jeremy Corbyn comes in, they could nationalise utility stocks. So that's another story you might want to think about.
It is indeed. Bitcoin. We haven't talked about Bitcoin. Come on, let's end on Bitcoin. What is your perspective on Bitcoin?
Bitcoin is just incredible, isn't it? See, the way I see Bitcoin, Donald, is I see it as a changing of the guard. I don't see it as an investment. I think this is a completely revolutionary type of process, because Bitcoin came in 2009. There are 21 million fixed supply coins in the world. Okay, the guy introduced it, had a great idea, introduced it, everyone thought he was crazy, and now he's sitting on millions of pounds of profit. But the concept is very good. And what's even more interesting is the technology behind it, which is blockchain. So we could now revolutionize the currency. I mean, the currency market is worth $4, $5, $6 trillion a day. That's the FX market. So if you imagine, let's say there's a complete change of guard, which may not happen now, but could happen in the next few years. And so people move away from currencies. You've got, for example, Bitcoin at the moment now that possibly could actually become regulated. It's got a better technology behind it. You don't have central bank intervention. You don't have QE problems, monetary policy.
But if it becomes regulated, doesn't that burst the bubble and all those lovely profits get lost again?
Well, Bitcoin as itself, I think, is quite dangerous to buy. I still think it will go up. I still would, recommending it to people to buy at the moment, although it's not regulated. So you've got to be very careful in terms of the speculative side of things. But there are other cryptocurrencies at the moment which people don't know about, which are still starting to come through. And again, we're still looking into it. So it's still very early stage.
So what are the cryptos that you like? Ethereum, or what else is out there that
there are a few out there, but I mean, at the moment, I think it's kind of, I probably wouldn't touch on them just yet because it's just too speculative. But what I am investing at the moment is the blockchain. I mean, I had an interview a few weeks ago, and the interviewer asked me a question, what are you looking into in the blockchain? There's a company called Online Media, changed them to a blockchain. At the time, they were at 40 pence a share. This morning, I watched them, they're at 125. Now, so the actual technology behind it is actually amazing. And what's also interesting is, for example, the Cypriot banks and the Greek banks who ban all these monetary policies, they are the ones which will suffer, I think, in the long run.
Ranjeet, we have to end it there. Thank you so much for joining us. Thanks to Ranjeet for sharing his views with us. And as always, thanks to you for watching.